Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Julia Pollak, Chief Economist at ZipRecruiter, joins us. Julia, talk to us about how you're looking at the labor market here in the U.S. Has it changed over the last several months?
Yes, but it hasn't changed along the margin that people were most worried about. So we haven't really seen layoffs tick up. And initial claims have been remarkably stable, even in Washington, D.C., Virginia, and Maryland, the areas where federal workers are most heavily concentrated. We haven't seen the impact of public layoffs on the rest of the economy yet. The unemployment rate seems like it's pretty stable, too. And there are a couple of reasons for that. One is that many of these workers are still on administrative leave. They're still on payrolls. The other, what we're seeing at ZipRecruiter, is that when these federal workers, even the ones who haven't been cut yet, just those who anticipate possibly being cut in the future, go out and look for jobs, they're actually faring better than the rest of the workforce. Really? So among those government workers who were just hired by a new job in the last few months, 76% said that job search went well, compared to 60% of the workforce overall. And among those who are still searching, 32% say their job search is going well. That doesn't seem like a big number, but it's 3 times higher than what we see among other job seekers. Only 13% say their job search is going well.
Well, that's interesting, because I thought with the jobs, the JOLTS number that we heard is that job switchers don't have the upper hand anymore, definitely in terms of salary. And that maybe job switching has sort of come down with that quit rate, not necessarily as high. That's not what you're seeing?
We are seeing that overall, but government workers are doing better than most. And it is true, though, that a pretty large share, about 40%, are taking a pay cut when they get that new job. We often hear about federal workers being paid so much less than they could make elsewhere, and they're sacrificing and to do public service. It's not always exactly true. Public sector wages are fairly high, actually. They're not necessarily lower than what people can get in the private sector, especially when you factor in total compensation, benefits, and the sort of value of job security. So people are taking a pay cut in much higher numbers than is ordinarily the case for job switchers.
Julia, what is the ZipRecruiter Job Seeker Confidence Index, and what is it telling you now?
Sure. So we measure job seeker confidence using a battery of 10 confidence questions. And then we also ask job seekers, every quarter about everything else that job search entails and how they're experiencing the labor market, what they expected to get, what they're actually finding. Job seeker confidence is almost back at sort of the lowest we've ever measured. All of the soft data has gone south recently. There was a brief surge of optimism in the fourth quarter, but the first quarter data is fairly weak. There's a tremendous amount of anxiety because there is just so much uncertainty in this economy. And then, of course, the labor market has slowed over 2 years. Hiring is very slow. And so it's a pretty good labor market if you have a job that you love. If you don't and you want to make a change, it's a pretty tough one.
We take a look at, say, some of the confidence data that we got earlier this week, Julia, and you're starting to see some people worried about their jobs, worried about the future, worried about their pay. Is that justified from what you see?
So I think that's a continuation of what we've seen over the last 2 years, where the labor market has cooled along multiple dimensions. First, hiring slowed and narrowed. So if you're in healthcare or local government, there's pretty strong demand for what you can do. But elsewhere, professional business services have added no jobs over the last 2 years. Tech has added no jobs over the last 2 years. And that's at a time when more and more Americans have actually entered these occupations and trained for them. We have more and more college graduates. We have more and more of those college graduates majoring in computer science. And so the labor market's not absorbing these new people into the roles where they want to be. About 50% are having to switch industries to roles they didn't want in order to get hired. And then we're seeing hours being cut too. So people aren't losing jobs, but they're losing hours. The work week is just 34.1 hours. That's a level we usually see in recessions. In good times, that usually hovers between 34.3 and 34.6 hours. And we're seeing it have effects. We're seeing it cause the share of workers who are part-time for economic reasons to hit the highest level since January 2019. And also, we're seeing the highest number of workers working multiple jobs. And they're not making, this is not just opportunity driven. Yes, we have a very flexible labor market where people are able to cobble together multiple gigs, but it's not people doing that to earn more than they would in one job. They're only coming out just as well, according to a study by the Fed.
Julia, for the longest time, really over the last several years, it just seems like employers have had a hard time finding and retaining workers. We even talked about hoarding of employees. Is that still a thing?
So the pendulum has swung back to employers, and most employers now are saying that that's not their biggest struggle. They, especially for most roles, we actually see pretty large numbers of applications per posting. If you're posting a job for, an HR or for a receptionist or for a PR manager, you are going to get possibly hundreds of applications. There are a few industries where employers are starved for talent. Those are sort of healthcare fields, physical therapists, occupational therapists, speech and language pathologists, nurses. Those roles are very hard to fill. And then the skilled trades, plumbers, electricians, carpenters, those are also very difficult. Yeah. Fortunately, we're seeing wages go up fastest in those sectors, in healthcare and manufacturing right now. And that information is actually getting through to job seekers. We're seeing more and more people enroll in vocational training programs and more people enroll in nursing programs.
All right, we really appreciate it, Julia. Thank you so very much, Julia Pollak, Chief Economist at ZipRecruiter.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Wendy Schiller joins us. She's a professor at Brown University. We love checking in with Wendy Schiller to get a lay of the land on all things happening down in D.C. So, Wendy, we look at these tariffs here. They're certainly front and center here for us on global Wall Street. How do the folks in Washington, D.C. think about this growing trade war that seemingly is being ginned up by this administration across a number of countries and a number of different industries?
Well, I mean, I think the Trump administration has announced really big tariffs and then pulled back, or implemented them for a day or two and pulled back. And so far, it sort of looks like a negotiating game. What can we get? But this is a deeper issue for the Trump administration. In the first Trump administration, there was a promise to make America great again and bring back jobs that had been lost from really 30 years, more than 30 years of free trade policy. Manufacturing plants closed and relocated, primarily in this case, to Mexico, to some extent to Canada. So you've got a situation where the physical plant is gone or shut down. And, Trump did not bring back manufacturing jobs in his first term. So there seems to be a commitment to put a lot of pressure to bring those back. But it takes a very long time to build a new plant or get an old plant up and running again. And it's cost prohibitive right now and in a global market. So how they do the second part of this is the big question mark. Slapping tariffs on costs consumers money in the short run. The argument is in the long run, it'll bring back jobs to America. But there doesn't seem to be a plan to do that right now.
So that's a great question. That's a great point, because I was asking that of Hugh Johnson just a few moments ago. And I was saying, look, the move away from, say, a government support or an economy supported by fiscal spend to an economy supported by private spend, is that in general something that is realistic? And what support do you think we need to see to then help those companies and help the private money?
Well, Alex, I think you can make an argument that we could reduce the size and scope and footprint of the federal government financially, in terms of people, in terms of regulation. You can make that sound argument, and you could actually try to implement that in a way that's gradual. You can't, it's like weaning off anything else. You've got a full supply of this for so long. People are quite used to it, and they make decisions based on it. Consumers, households, businesses make decisions about the flow, continuing on the flow of federal money and free trade. So you take both of those away at the same time, I think you really bring the economy, not to a halt, but certainly do a lot of damage, not only to current spending, but future planning. And we're seeing consumer sentiment going down. We're seeing people pull back. Now, if you want to buy a new car, if these tariffs hold, then it will be more expensive. Or remind people of the supply chain issues under COVID, when cars cost anywhere from $3,000 to $6,000 more than they should have. That will slow down consumer spending. And as you say, Alex, consumer spending is still a big engine that drives the U.S. economy.
Wendy, I'm thinking about where the president's support is here, where maybe some of the Democratic support might be. And I think we've got something coming up in Wisconsin next week, an election for the state's Supreme Court. I know Elon Musk has spent a lot of money in there for the GOP candidate. Are you looking to this state Supreme Court kind of situation in Wisconsin next week? Is it any kind of referendum on where the president's support might be?
Paul, this is a great question. Democrats are trying to really rally their base, and they haven't really had anything to latch on to that's hit everybody, right? There hasn't been a massive national impact from some of these policies yet. But these small elections, there's one in Pennsylvania for state Senate, Democrat won in a Republican district. Florida, there's 2 congressional seats. Those polls are looking much tighter than anybody would expect in Republican-leaning districts. So this Supreme Court race is getting a lot of attention. If a Democrat or a liberal wins, then the court stays a little more liberal. If the conservative wins, it reverts back to being more conservative. So it's a benchmark, but there were lots of these benchmarks leading into 24, and the president won easily. So I don't think it's a big harbinger of national trends, but I do think that if it starts to build pressure at the local level in states like Wisconsin and Pennsylvania on Republican members of Congress, particularly Republicans in the House, then signals get sent to the White House that maybe they need to change some of the things that they're doing. But we're a long way from that.
Well, a long way from that. And also, we're sort of moving towards a phase 2, right? So you get the tariffs first, and then hopefully the tax cuts and deregulation. How soon do we have to get that phase 2 to calm any sort of underlying chaos?
Well, I mean, the tax cuts are something that people talk about and they get sort of encouraged about. But remember, that's a long process, too. When they come in, that's a complicated process. The House and Senate are going to come in very different in their packages on the tax bill. There's lots of different things. Earned income tax credit, for example, people who are poor or people who are low income, is that going to still exist? There are things that will affect all levels of the economy. And so it's not clear that it will be a win for the Republicans just to pass the bill. It very much depends, obviously, what's in the bill and who it's hitting and who it's helping. So I think those effects don't happen really until next year in terms of the psyche of America. But, the Biden administration left Trump with high inflation. We can all agree on that, but a relatively robust economy. And now that economy is starting to look very shaky. And that's the big question mark for the Republicans in the Congress. Do you want to wait till that actually happens and you're looking at 2026 right in front of you? Or do you want to try to forestall that with the Trump administration now?
How big, Wendy, is this signal chat situation for this administration?
On Tuesday morning, I was talking about it and I thought, well, people make mistakes. People use apps. They add people by mistake. And I didn't see the Republicans sort of getting riled up about it. But the Senate Republicans in particular, Republican senators are very unhappy about this. And Republican hardliners in the House on foreign policy are unhappy about it. And they seem to have come together to say, clean up your act. Trump will not get rid of anybody tomorrow, but Trump will get rid of people if they are not serving him well. And I think this is sort of a signal, literally, no pun intended, make sure that this doesn't happen again. If it happens again, then people start to think, okay, we don't have any confidence in the Pentagon or the leadership of the Pentagon and the national security team. That affects us worldwide. I think that's something Trump would have to pay attention to.
When we take a look, say, at foreign policy, we just broaden that out then for a moment. How significant and kind of where are we in the talks between U.S. and Russia about Ukraine? When can we really expect more movement here?
Well, I think Trump has basically indicated Putin, look, you're going to walk away. You could walk away with some victory here. If you end it, then we stop sending the arms. We stop aiding Ukraine. And you walk away with some territory and you're not getting all your people killed. Like, this is a good deal for you. And we will get some mineral rights, or we'll get some natural resource rights. We'll get some stake in Ukraine. I mean, that's the ideal situation, frankly, for all the parties involved. The United States gets a stake. Ukraine still has the United States on its side. and Russia gets out of a difficult and expensive war. But so far, Putin's not biting, I think, the way that Trump had hoped. But I do think that's a consistent position the United States can maintain. There's enough support in Congress for continued aid to Ukraine. So Trump wants to keep that going. He can get that permission and that aid from Congress. It's Trump that's been saying it's not a good deal for the United States. So I think in that way, they're sort of waiting for Russia to decide this is the best they're going to do. And so far, we're not getting the signal that Putin thinks that it is the best that he can do.
Wendy, thank you so much for joining us. We always appreciate getting a few minutes of your time. Wendy Schiller, she's a professor at Brown University.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Let's talk about TMT here. I want to talk about technology stocks. We got the NASDAQ. It's down 10% year to date. That's a correction, kids. I don't know. And if you need the tech market to lead this market higher like it has forever, do we have a problem for this market? Melissa Otto joins us. She's head of TMT research for S&P Global Visible Alpha. Melissa, when you talk to your clients, are you positive about tech these days or not? Has it played itself out, at least for the near term?
Good morning. Great to be here. Tech is a bit all over the place at the moment. I think there's an overhang of uncertainty for companies that have China exposure. There is a shifting of tides as companies are moving toward different aspects of AI. And then there's a bit of slowing, as companies are more exposed to the consumer. So I think it's a tale of multiple aspects there.
And what I found so interesting about the Mag 7 slide yesterday, down 3%, is that some of the individual stories for within the Mag 7 were all kind of different, right? Like TD Cowen had a note out about Microsoft canceling some data center projects. Tesla was cut to hold. NVIDIA might have some issues with some China energy rules for chip imports. Google said that Millennium said that Google could lose younger users to OpenAI search. Like there were different things. There wasn't a theme. Which is the biggest stressor for these guys right now?
The biggest stressor right now, I think, is whether or not we're going to really see inferencing at scale. Mm-hmm. And what that means is that there's been so much infrastructure spent. I mean, I've been on this show talking about the billions and billions and billions of dollars in CapEx that we've seen from the cloud service providers that have gone into data centers. And what is that ultimately going to net? What's going to be the ROI of that for all of the companies that are leveraging and using that compute? And I think that's where we really haven't seen a viable business model for generative AI, where companies are leveraging this and then the output of it still remains somewhat dicey, especially for more complex. Anything that's got a little bit of complexity around it is still not seeing the accuracy that it requires.
NVIDIA, it's down 15% year to date. I think a lot of people who don't traffic in this stuff every day, we kind of look at NVIDIA as kind of my litmus for all things AI. It's down 15% year to date. Yeah. What does that tell you?
Yeah, that's an interesting one. They had their big GTC conference last week. Jensen gave his 2-hour plus keynote. Right. One of the interesting things, though, from that is that Blackwell is continuing to see really strong demand.
And that's their new chip?
It is, okay. Yes. It's really a solution. It's chip plus software and some other stuff in there that essentially enhances the compute, lowers the energy, makes it a lot more cost efficient. The critical thing coming out of that is what's been happening to estimates. We've seen Blackwell, B series, B200, B300 expectations come up 15% for Q1, which tells me that, expectations are getting a little bit more positive coming into next quarter, and that maybe we're starting to see a bit of momentum.
Okay. The other interesting side of this is the infrastructure build out, which leads me to CrowdWeave and its IPO. What did you? Yeah. Okay.
Yes.
So I've had a lot of tutorials with Anurag because I'm
okay,
I gotta understand like all the differentiation here. So what do you make about this potential IPO and sort of where it's gonna price at? Like, what is that gonna tell us about the thirst for AI infrastructure?
Yeah, I mean, the valuation is going to be critical. What sort of multiple they come in at, and it's just going to be a temperature check for sure.
Does that, in terms of what? Like, is it in terms of how the big guys are spending? Is it in terms of like the inferencing versus the LLMs and training of it? What's it going to tell us?
All of that. I mean, I think right now there's so much uncertainty. There's such an overhang in the market of everybody just shrugging their shoulders and saying, can we get a bit of clarity? Can we have a benchmark? Can we have something out there in the market that's going to give us an anchor? And that IPO may be one of those.
So what's single best idea right now?
Single best idea? Wow. That's a good question.
I mean, when I ask a tech person, I just say, if somebody asked me that, I'd say, hey, Microsoft. I mean,
I will say, coming out of GTC, and I feel like I said this last year to Alex and Ed in the tech show, is that Jensen continues to talk about Dell. And,
there we go.
We're continuing to see a lot of, closeness in relationship between Dell and NVIDIA. And I feel like that end-to-end solution at the edge may be something that could be a catalyst for the next upgrade cycle. And the market's been waiting for this upgrade cycle for like 9 months. And maybe we're going to start to see it in the second half of the year. And that's not really priced in yet.
All right, good stuff. Melissa Otto, thank you so much. Appreciate that. As always, Melissa Otto, she's head of TMT Research, S&P Global Visible Alpha.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Joining us now is Leslie Palti-Guzman, Senior Non-Resident Fellow over at CSIS, which is Center for Strategic and International Studies at NYU University SPS Center for Global Affairs. Where I sit, the gas question is quite important. Europe is still buying some Russian gas. If there is a resolution to the war, does it ramp up again to the kind of levels that we saw pre-2022?
That's the question. So for me, Russia has been playing the long game all along and has been hoping potentially for the return of more of its commodities. And Europe didn't wait for the US and Russia to start a reset. Some European business interests had already in mind potentially a return of more of Russian gas, especially because of the lack of competitiveness right now in Europe. I think some pro-Russian parties in Europe, extreme right, had already mentioned that. We were starting already to see some discussion around it. I think there will be nothing before a peace agreement. So it remains very preliminary, but I think utilities in Europe, without vocally screaming that they will be happy to get some Russian molecules that are potentially less expensive and will bring down the prices in Europe.
But Europe seems to have done a good job, Leslie, of kind of getting by without the Russian energy sources. Is this something that can be a longer term play? Do they want to not go back to Russia for any reason?
Yeah, that's a tricky question.
Yeah.
I think the trust has been broken. It will never come back to the 40% of market share that Russia had in the European imports of gas. But I think 20% is a possibility. And 2024, it was actually 18%, both pipeline and LNG imports from Russia. And now it's way down because there is a line via Ukraine that is completely out of service. There is no more molecule going through this line, but the Turk Stream is still running, and the Arctic LNG, the Yemen LNG cargo is still coming into Europe. So we still have some flows. They never left, and they could ramp up a little bit more. But again, there are many not resolved issues. First, there is a question of trust. Gazprom has many penalties it needs to sort out with the European utilities. So Gazprom owes a lot of money to this company. I don't think they will sign again long-term contracts like they did before. I don't know what kind of arrangement can be found, but it's very preliminary and it's going to take time.
And that's what's so cool about commodities is that it'll sort itself out, right? Like if more gas does come on the market, Europe may not buy it, but it also means that you'll shift the flows around in terms of where all that
Molecules.
LNG and gas goes. Yeah.
And to your question, I think Europe doesn't need the Russian gas, especially 2026, 2027, when we see a much better, well-supplied global gas market.
Yeah.
We have much more supply coming online. So this Russian gas can actually be displaced by other sources. And this is one of the contradictions from the Trump administration, is that the baby drill agenda doesn't go along with bringing back more Russian molecule into Europe, because it's going to displace potentially US LNG.
Before we let you go, I want to talk about the crisis in the Red Sea, which basically, when you have vessels needing to detour around the Cape of Good Hope, that just makes it crazy for freight rates. It makes everything very difficult. Could we see a world where things calm down in the Red Sea and things can be shipped through? And how do we get there?
Yeah, so I think 2025, it's not out of the question that we could see a restoration of the Red Sea route. However, the Houthis need to be deterred again. And the US need to remain very convinced that freedom of navigation is in the interest of the United States, but also the rest of the world. And there are many other positive externalities for restoring the routes. For all the goods from the US to Asia, they would really benefit from the shorter route. And we need to remember that the Panama Canal is also much less used because of the draw. So we have two routes right now that are not at their full potential, the Panama Canal and the Suez Canal / Red Sea. So we cannot believe that we're in a better place without this route. And also, I think Washington is sending a message to China and to Iran by being aggressive there, because China is watching, and China is looking for itself what's going on in the South China Sea, and if the US will be strong there.
Yeah, I'm Google mapping the Red Sea as we speak. It's important, it looks to me, as it relates to the Suez Canal, like for
correct.
global trade. So I'm learning a little bit here as about the Red Sea. Leslie, thank you so much for joining us. Leslie Palti Guzman, Senior Non-Resident Fellow at the Center for Strategic and International Studies and NYU SPS Center, talking a little geopolitics as it relates to global trade.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.
Ben McMillan joins us. He's the CIO of IDX Advisors, joining us live here in our Bloomberg Interactive Broker studio, up from Tampa, Florida, the winter home of the New York Yankees. Opening day here at the stadium, 3 o'clock first pitch. So there'll be lots of folks running around the city in their Yankee uniforms. Ben, what are you looking at in this marketplace? How are you seeing kind of what's unfolding here? It's been a tough start to 2025.
It has. I mean, like you said, markets hate uncertainty. This is Finance 101, and we're seeing it play out in real time. And, my big takeaway is kind of the big reversals that we've seen, depending on the headlines. In fact, I think Bloomberg actually broke a story yesterday that some of the auto tariffs might hit, yesterday afternoon, and we saw this huge reversal from up in the day to, down big, and that's just a continuation. And so we're looking very closely at kind of the engine of the economy, so GDP and the consumer. And this is kind of the conundrum we've seen. The hard data is looking pretty good, the sentiment data not so much. So, we're kind of peeling back the layers there, and we want to understand, is that sentiment data potentially an early precursor of stuff that's going to show up in the hard data?
So aside from that, which is the macro thesis, what do you make of the decline that we've seen in tech, and particularly the AI trades? What are you telling clients?
Well, I think you hit the nail on the head. This is part of the hype coming off, and we saw this. I'm old enough to remember the dot-com bubble, where it's like you put pets.com, and all of a sudden it's this mega billion-dollar company, and then people starting to realize, well, all right, a lot of growth is being built into that assumption, and if we have interest rates back up, or God forbid a recession, even a mild one, that can really take a lot of that valuation out of the growth trade. And so I think that's what we're seeing, and I think that's also why we're seeing a bid for treasuries too. Is just kind of a flight to safety as people reassess how much they want to pay for growth.
Look at this. I mean, you're looking at a world of hurt out there. Gold up another $16.
Yeah, that's a tremendous run. Yeah.
I mean, that Goldman Sachs call of a month and a half ago, 3,100 gold. Boy, that looks good. Is that something you talk to folks about?
Yes, gold is probably, it's hard to put conviction in a market like this, especially when you've got, kind of different headlines and a lot of what I would call exogenous risk factors. Gold is probably one of the highest conviction bets out there, we think. And in a lot of our client portfolios, we're putting in positions in gold or telling people they should think about this. And I've been surprised, to be perfectly candid. A lot of our institutional clients, gold has really not been on their radar. And, when you look at the big structural threats out there, not just this year, I'm talking, 3, 4, 5, 10 years out, gold is really a good hedge. And then let's not forget not the least of which is all the central bank buying. China, India, now even some of the emerging market central banks are literally selling treasuries and buying gold. China's even going so far as to kind of obfuscate their buying to hide it from the marketplace. So that's not a trend we see reversing anytime soon. And we think gold is going to set all-time highs, every year for the next few years.
JP Morgan had a great note out on this that looked yesterday that looked through the different cycles of gold buying and what drove gold, say, in the last 10 years. So real yields, for example, on the dollar is not necessarily driving it anymore, and driving it more because countries want that gold because of the sort of renationalization and the geopolitical strife and needing to make sure like the money's in the country kind of thing.
Oh, absolutely. Yeah. And, if you go back 10, 15 years, kind of the biggest marginal buyer of gold was jewelry, especially in countries like India. And then all of a sudden the ETFs, started getting more traction. And now central banks, if you look at their gold purchases, it's basically, it's up orders of magnitude just really since COVID. And you made a good point about real yields. Ironically, we're fundamentally a quant shop, and we had a real yield gold model that just, worked perfectly right up until COVID. And then it just, the world changed, as Gunlock said. We're in a new normal, and you can't price off that anymore.
Fixed income, what are you doing in the bond market these days? Are you sitting in 2-year treasury at 2%, or are you taking some credit risk?
We're a little bit of both. So we've got different products depending on client preferences, but generally speaking, sitting in the short end of the curve. If you're going to take credit risk, do it in things that are, senior secured. Some good, we're big fans of ETFs out there just because of the liquidity they provide. There's some good, AAA CLO ETFs, short duration credit. But yeah, spreads are starting to widen. And, once credit spreads start to widen, that's not a highly mean reverting series like something like the VIX that can come back down quickly. That's generally indicative of, forward-looking, clouds on the horizon, so to speak. And so we're generally, taking a very cautious approach to credit, if at all.
Interesting, because I feel like that's an area where many say it could be a lot worse, so we want to take that risk to get the yield.
Well, and people are stretching for yield. That's part of it. And that's part of the client conversations too, is, don't necessarily go out on the duration curve. Often, to be candid, we're having more of those conversations about not stretching on duration for yield, but people are really reaching for the credit yield. And so that's another thing when, we're kind of looking at, the two different outcomes. Do we have a soft landing, or do we have a productivity, growth pull out of this? This is where you really, we think, want to be very mindful of the risks you're taking, especially in credit. And then keeping an eye on the 10-year. Actually, on yesterday's show, you had a woman, I think from SocGen, who made a very compelling case for 10-year yields going down to 3.5. There's a lot of compelling cases why they could go up to 5. And I think that's emblematic of where we are. It's just, it could go either way with kind of equal probabilities. And so you just got to, really watch the till, so to speak.
Ben, thanks so much for joining us. Really appreciate it. Ben McMillan, he's the CIO at IDX Advisors.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.